Hello, friends. Hello, friends. Hello. A very warm welcome to you all once again. I'm extremely happy to see such a large turnout here to listen to this discussion on investing with youngsters like you all. Often in India, we see that people are not interested and neglect investing till the age of almost about 35 to 40 years. Very rarely do we come across this type of situations, and that is why I am thankful to you all. You all have decided to improve your life and got inspired to start investing early in life. This is really heartening, friends. We have gathered here to talk about mutual funds. I have seen and would like to share one of my experiences. I started working in mutual funds around 25 years back. I came to Mumbai from a small town. When my mother came to know about my job and company background, she got worried and asked me why I chose mutual funds. It's a gambling market which invests in stock market. Who is going to invest in your mutual fund? How will you grow? Etc. etc. See our emotions, friends. This is the very same mutual fund which has completed the journey of 25 years, wherein my mother was skeptical, saying, who would invest in mutual funds? And today, people who used to refuse investing in mutual funds are insisting on investing in mutual funds. What has changed? Let us try to understand that. I think many of you all are prospective investors, and you would be having this question in your mind: why do mutual funds always write subject to market risks? And if they are risky, then why should I invest here? Because the foremost criteria which we consider while investing is the level of safety. Friends, investing is not a science. There is nothing right or wrong in investing. Suitability is relevant. Appropriateness is important. What is appropriate for me? And the problem is, often what is appropriate for me is not appropriate for others. And we often take inspirations from others before investing. We often ask others where to invest. And this creates confusion, friends. Economics is one such subject in the world where you cannot easily make out what is right or wrong. I can give you a very recent instance of the same. In October 2013, two economists got Nobel Prize awards while both of them shared contrary views. Is it possible? Two economists, both having contrary views from each other, yet both of them get Nobel Prize together at the same time. What does this mean? There is nothing right or wrong. I have borrowed rupees 1,000 from you. It's a cause of worry for me. But if I borrow rupees 1 crore from you, then it's a cause of worry for you. Isn't it? There's nothing right or wrong here. Right? What will we try to understand here? What is appropriate for me? Right? I can give you one more instance. Whether you are correct or not depends on where you are standing. If I write 6 here, I can see 6 here, but you will see it as 9. Can we debate as to who is correct? No. To become a good investor, you have to first find out your objectives. Never rely on others' perspectives. What do you want? What is guaranteed? What is safe? Let us try to understand it. Why do we like guarantee? It's really amazing, friends. We like the guarantee which God has not given us. I will take it up later. Here let us see why do we like guarantee. Because guarantee gives us peace of mind. The guarantor promises to deliver the performance which he has committed to you or agreed to you. But then the question is, what if he is not able to perform? If he is not able to fulfill the guarantee, then what will happen? The person who gives you the guarantee has to take insurance. Guarantee does not just come like that. Guarantee can be given only when insurance is taken. And when you take insurance for guarantee, there is another issue. What is the issue, especially in investing? Investing leads to income. Income can be in various forms, and it completely depends on consumption. How much will people living in India produce and consume? That will decide India's income. India's income keeps on increasing or decreasing every year. It is always variable. It does not grow in a linear way. Many of you all who are not salaried and have own businesses, you would have seen your income keeps on fluctuating. And you expect guarantee in such a scenario where income keeps on fluctuating. So what will be the outcome? Higher the gap between performance and guarantee, higher will be the cost of insurance. Let us understand the cost of insurance and guarantee and mutual fund and fixed return, which we have been seeing since past generations, and what is the difference in them. Friends, we like safety, certainty, and assurance very much. Wouldn't it be great if everything in the world would be safe? Have you heard of this great personality by the name of Helen Keller? Have you heard about her? Helen Keller was that lady who lost her sense of sight, sense of hearing, and sense of speech at the age of 2. That means she was blind, deaf, and dumb. Imagine you are given a 2-year-old kid who is blind, deaf, and dumb. Can you even imagine teaching ABCD to that child? How will you teach? You will show A, she can't see. You will say A, she can't hear. You will tell her to say A, she can't speak. How will you teach? But she got a great master, and that lady is considered to be one of the greatest intellectuals till today. And what does this lady have to say? She says, this world is a creation of God, and security is mostly a superstition. It does not exist in nature, and nobody can completely experience it. She tries to say that when God does not give guarantees, safety, security, how can you expect it from humans? And that's what we search. That's what we always search. She also says a beautiful thing that more you seek safety, higher will be your exposure to risk. It is true that the desire for security, stability, and safety is not wrong. If you want your life to be safe, if you want your life to be stable, if you want to avoid dangers, then I would say there is nothing wrong in it. But friends, it's just not real. Are you getting the point? You want your life to be trouble-free, worry-free, always safe. There is nothing wrong in desiring it, but it is just not practical. It does not exist in this world. It's not real. It's like a boyfriend telling his girlfriend that he can bring the moon for her, which is simply impossible. Expecting moon is not a bad thing, just that it is not real. Right? So why mutual funds don't give guaranteed returns? Then the question is, why should we invest in mutual funds if they cannot give guaranteed returns, if they cannot give fixed returns? That's the big question. The straight and honest answer to this is that if you want fixed and guaranteed returns, you should go to a bank and not a mutual fund. Why are we mutual fund? Because we are not a bank. We cannot have banks' characteristics. Bank and mutual funds both have different styles of functioning, isn't it? Mutual funds' objectives are different than that of banks. What is the difference? Let us understand why a mutual fund does not give guaranteed returns. See the interesting part. Bank and similar institutions give you fixed returns, that's true. But are they really guaranteed? Please find out. Are they guaranteed? Please find out. I agree that the bank fixed deposits give you a fixed return, but please find out yourself whether they are guaranteed or not. Friends, mutual funds aim higher returns. They try to give you the maximum returns without taking additional risk. Listen carefully, it is called risk-adjusted returns. Within the given risk framework, earning the maximum returns for the investors is the prime objective of a mutual fund. So why did mutual funds set this objective? There is a big reason. First reason is that investors are generally locked into a relatively low rate of return. When you go towards fixed returns, they tend to be low. If the returns are high, it is possible only when the government subsidizes those returns. And world over, governments are coming out of subsidizing returns to such an extent that government has stopped giving guaranteed pension for all its employees too. See where the future is heading. Okay? Second point is that guaranteed income products often suffer from poor liquidity. Whichever instrument has fixed returns, guaranteed returns, often you will see that the liquidity offered tends to be very weak. Liquidity is very necessary. If liquidity is not there, you will not be able to use your money when required. Third point is that in most of the cases, these products may not keep pace with the rate of inflation. This is a very big threat, friends. Because returns are low, liquidity is not there, this directly affects inflation. If inflation rises, your returns will be lower than even inflation. You invested for profit but face a loss. You did not get the real rate of return. Limited options and guaranteed income products, even pension and retirement options today, are defined contribution plans and no longer defined benefit plans. The combination of low interest rates and longer life, listen carefully to this point. It is really astonishing. Friends, our life expectancy is rising. And I can confidently tell you that all my youth friends in this auditorium will live for more than 100 years. But fixed returns are diminishing world over. Your age is rising and the gap is rising. What will you do to reduce the gap? You will have to maximize your returns in risk-adjusted manner, or without increasing the risk, or within limited risk framework. And this is exactly what a mutual fund tries to do. Mutual fund gives you an opportunity to participate in a growing economy. Do you know why do we write mutual funds are subject to market risks? Mutual funds is a mode of investing and not the destination for investing. Mutual fund invests in deposits, stocks, they invest in bonds and also in gold. These are the assets in which mutual funds invest. But when a mutual fund invests in a bond, it goes to the bond market. When it invests in stocks, it goes to a stock market. There are several trades daily in the market. Due to daily trading, the price keeps on changing daily. And when the prices change daily, mutual funds NAVs also change daily. That's why we write mutual funds are subject to market risks. Right? It does not mean that the risk is high. There will always be volatility and ups and downs. Risk is determined by the type of mutual fund you have invested in. In liquid mutual fund, there is very less risk and high stability. In bonds, the volatility increases a little. And in stocks, the volatility further increases. If you invest in sectoral funds, the volatility is even higher. You can determine what type of mutual fund you want to invest in, and whether the mutual fund is performing well or not can be very easily determined. In bank, you can never determine how they are performing, how good or bad they are doing. In banks, the NPS which you are seeing today, the investments were made several years ago. We did not come to know for so long, but today we can come to know about it. But how's a mutual fund performing can be easily found out. You have a very effective control mechanism over mutual funds thanks to the law and regulation which tells them to publish the NAVs daily. You can easily track the drop in the market and the drop in the mutual funds NAV, and you can see it and easily decide whether they are performing well or not. What a brilliant tool you have. The liquidity offered at the market rates to assess their performance in given market condition, and that itself protects the interest of the investors. This is such a beautiful concept. The liquidity offered to you, the daily NAV offered to you, you can redeem your money easily at any given point in time. If it is not performing as per the objective, you can easily compare it with the market and take a decision to withdraw your money. This protects the investor's interest, friends. This is a difference with a mutual fund. Mutual fund gives you market-related earnings and banks give you contractual earnings. Banks borrow money from you. Mutual funds manage your money and they do not borrow money from you. It just takes a fixed fee from you. If you have given 10 rupees to the mutual fund and if it grows from 10 to 15, it will pass on the entire amount to you except its fees. But if the bank has taken 10 rupees from you and has committed to you a certain rate of interest, whatever it is, let's say it's 8% per annum, then after 1 year, it will give you 10 rupees 80 paise. But if it earns 15 rupees out of it, it will retain the balance 4 rupees 20 paise. This is called spread. So the bank earns for itself from your money. It works for shareholders. It tries to maximize the profit of shareholders. But mutual funds work for unit holders like you and try to maximize your profit. What is subject to market risk? I would like to tell you. I would give you one small example to explain this. Is there anyone in this gathering who has a 3 or 4-year-old kid? Anyone here? I will share my experience. When my son turned 3, we sent him to school for the first time. And the school management told us that your child will be back at 12 noon. I was at home on the first day of the school, and at exactly 12 noon, I and my wife, both of us were standing near the gate waiting for the son's school van. It was 15 minutes past 12 and he had not yet reached. Imagine our state of mind. We started panicking. Why? Because we know that there is risk in the school. 3-year-old kid is safe at home, but certainly not as safe in the school. Anything can happen in the school. There can be an accident. Some kid can push him. He can fall and someone can kidnap the kid. So many incidents happen in the school which we all hear about. We all know that a 3-year-old kid cannot take care of himself. There are so many risks in the school. Then why do we intentionally put them to risks? At home, he is in total control of the mother. He is in full supervision of the mother. But as soon as the kid goes far, mother panics. So why did my wife put our son in danger? Do you know why? It's quite simple, friends. My wife wants our kid to grow. And for the growth of our child, it is necessary to put the kid in danger. But what does an investor want to do with his money? He wants to save it. That's why he does not want to take risk, friends. Do you all love your money more than your kids? Isn't it amazing? That's not the case. You love your kids more than your money. Then why do you want to put your kids to risk and not your money? Because you don't know what you can expect from money. You just need money. But you know what to expect from your kids. You want kids' growth. I have not come across a single parent who would say they want to save their kid. Every parent wants their kids to grow in life. But the investor says he wants to save his money. Dilemma is here, friends. Come out of this dilemma and you will not see it as risk. Facing the risk is the only way to mitigate risk. Thank you for your time. Namaskar. Jai Hind, friends. Thank you. Thank you. To watch more such videos, subscribe to our YouTube channel. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.